So why are mortgage rates going up when the Federal Reserve keeps lowering rates? Well, that's a question a lot of people are asking. The answer might surprise you. It's not about the Fed's rate cuts. It's about something called the 10-year Treasury Bond. Let me explain this the simplest way possible, like I'm speaking to a 10-year-old, so stick with me. First, let's talk about what the Federal Reserve does. The Fed controls something called the federal funds rate. This is like the interest rate banks charge each other to borrow money overnight. It's important for short-term things like credit cards and car loans. But here's the thing, it's not directly connected to mortgage rates. Mortgage rates actually follow something else, the 10-year Treasury Bond. Think of this bond as a loan to the US government that lasts for 10 years. When investors buy these bonds, it means that they trust the government to pay them back with a little interest. The interest rate on this bond, called the yield, is like the compass for mortgage rates. When the yield goes up, mortgage rates go up too. And when the yield goes down, mortgage rates usually follow. Now, here's where it gets really interesting. The bond market is huge. The total US Treasury market, which includes all bonds the government issues, is about 25 trillion. That is a massive number. And the 10-year Treasury is one of the most important pieces of this market. It's so important, it's like the backbone of our economy. Everybody watches it, and it sets the tone for long-term investing like mortgages. But lately, investors are selling their 10-year Treasury bonds. Why? Well, two big reasons. Our country has a massive amount of debt, and inflation is rising. So when investors think inflation will keep going up, they want to put their money into things that will grow faster than the inflation, like stocks, real estate, or other assets. They're saying the 10-year bond isn't the best place for my money right now. And when they sell, the bond yield goes up, and so do mortgage rates. Back in 2020 and 2021, the Fed stepped in and started buying tons of 10-year Treasury bonds. This kept the bond yields low, which helped mortgage rates stay low too. But today, they're not doing that. Unless the Fed steps back in and buys more bonds, mortgage rates are likely to stay high or even go higher. So, the next time someone asks why mortgage rates are rising when the Fed is lowering rates, you'll have the answer. It's not about the Fed's short-term moves. It's about the massive bond market, the 10-year Treasury, and what investors are doing with their money. Remember, money goes where it's treated best. And right now, investors think there are better places for their money than the 10-year Treasuries. Thanks for watching. If you found this helpful, don't forget to like and share this video. If you have any questions about mortgage rates, feel free to drop them in the comments below. See you next time.